that, Jason. I'm sure you had a bit of a heart attack.
just nearly.
If all of you don't, or for all of you who don't know, I'm up in Johannesburg at the moment. That's why you can see my beautiful hotel room backdrop. And we've got the FinTech Awards tomorrow, so we're presenting at the FinTech Awards. We've been nominated in the top 3 in Africa, which is really quite exciting. And just on that basis, I'm in a hotel room, and I had 350 megs of data that I logged in 15 minutes ago, and it ran out by 7 o'clock. So the reason I'm late, I apologize, was that I was buying more data. So tonight we've got a really interesting presentation put together. You know, for me, we wanted to talk a lot about Kensington and some of the opportunities there. I've personally invested in those opportunities, and yet I also wanted to share with you, because I tell you, I've been very, very frustrated with the whole fees must fall campaign. You know, I went to UCT and I put myself through university. My dad went bankrupt when I was 17. So I put myself through university, and I also did my master's in London, and I put myself through my master's. So I've got complete disdain for people that want things for free. I personally think that if you don't pay, you don't pay attention. And the bottom line is, I know it's possible because it just takes a bit of hard work. Now, on the basis of that, you know, gives me, my son is 4.5 years old, and I sit there going, well, what's the solution for Jonty? Now, the question is, will he even want to go to university? Well, who knows, because I plan to train him to be an entrepreneur from a very young age. And yeah, my university days were absolutely amazing, so I wouldn't ask him to miss that for anything. But the second question is whether all the information will be online. So, you know, I think really for me, it's just taken into context. There are a lot of people online tonight that haven't met or seen us before. And so I just wanted to give you a little bit of an update, just so that you know where we come from and what our context is. I've also done quite a lot of work on explaining, and ultimately I did it as a father, just working out what I would need to do or continue doing to ensure that my son can go to any university in the world. I don't believe that there's anything that could be worse than being a parent where your children come to you and you say, you want to go, you know, study at Harvard. I just managed to get in, Dad, and then they can't afford to get in. So just before I get started, Kevin and Jason, are you guys seeing the video and the screen and everything?
Yes, got we've seen it.
Okay, so you've got the plan B, why and how university screen up.
Correct. Yeah, everything's visible.
Great, so let's rock and roll. We've got an exciting night ahead, and I need to watch the time because I've got about 3 hours worth of information to share in a short amount of time. So let's get started. I think really, you know, for me, when I flew back on Sunday, this was the newspaper. It was all about D-Day to save Wits, and the thuggery, and, you know, this whole fees must fall, and, you know, naked-breasted women trying to take on police with rubber bullets and stun guns. You know, I'm not sure what you guys think the people around the rest of the world think, but I'm really worried about the impact that this will have, not only on the grading of the university, but actually on foreign direct investment at large. And you know, so let's not go worry about that in too much detail. I think our finance minister, Pravin Gordon, being summoned on yesterday is equally a major problem. They're talking, Davy Rood's talking about now, it's pretty much guaranteed that we will be downgraded in December unless they do something. So, you know, we need to, as investors, you know, I'm not sitting out to talk about negative news, but we as investors need to be cognizant of what's happening. The last thing I would say as well is that from experience, I've been investing overseas since I was 22 years old, which I'm embarrassed to tell you is 18 years ago now, so I've been doing this for a while. And for some reason at Christmas time, it's almost like the government spends all the money or something. But at Christmas time, going into January, the Rand always devalues. So if you're looking to invest, based on the fact that we've got overseas, if you're looking to invest overseas, based on the fact that we've got a credit rating review in December, and statistically the Rand has always fallen and weakened in January, February. I can prove that to you if you want me to, or go and look at James Planer's graphs, or speak to Andrew Rizek if you want to. You know, it really gives you a bit of emphasis as to what to do in October and November before you go on holiday. And you know, what better thing to go on holiday with the peace of mind of knowing that you've got it. So I'm going to share with you tonight 4 things. The first one is how to have peace of mind. So, you know, I don't know if you saw the pictures, and I don't have a picture with me right now, but my son got his British passport just yesterday. I think there's actually a slide coming up. Wealth preservation, the Rand goes up and down, but the bottom line is it statistically loses 6% against the US dollar every single year and has done for the last 30 years. Now, granted, it's not a one-way curve. It goes up and down, which is why we use James Painter. But the bottom line is if you're taking a long-term view on investments, you need to take that into account. And ultimately, it's a plan B. I don't necessarily want to leave South Africa. I love living in Knysna. I love South Africa, actually. But I also don't want all my eggs in my... And I think, really the next word is the one that I love the most. And we were sitting at Henny Note, my co-founder and business partner, Game Farm, back in January 2015. And he said, we need to do this, not because we want to, but to ensure that South Africans get to be able to live in South Africa because they want to and not because they have to. And for me, I think the most important word is freedom. You want to live, I don't care where you want your kids to go to school or university. I actually don't care whether you want to give your money to the church or invest it in a charity. But what I do care is that you have the freedom to be able to do that. And I think as a team, we passionately try and pursue that to be able to help people have their freedom. My story, where does it come from? Yes, I'm opinionated, but where does it come from? Well, ultimately, I grew up having a father and an uncle. It was a story of two brothers. Hang on, I'm going to have to stop this 2 seconds. Hello? I'm not good. I'm in the middle of a webinar. What's up? Okay, call me back in office. Sorry about that. There's no way to switch off a hotel phone. So there was a story. You can now see it's live and not scripted. So you can see it was the story of two brothers. So it started off with my father. He always wanted to be a farmer. His family was farmers. We lived in Zimbabwe since the late 1800s. We had 3 farms in Zim. And in 1976, due to the terrorists, a number of people were killed. My parents basically were run off our farms. My parents packed their bags, got in a car, and literally drove to Durban with whatever they could fit in a car. Unfortunately for my dad, he lived a very reactive life. He studied to become a chartered accountant. He was actually FD of Rainbow Chickens. But he always wanted to be an entrepreneur, and he went on his own when I was 40. When he was 49, I was 17, and he actually went bankrupt. And unfortunately, for me, I watched a man that really wanted to be an entrepreneur, but lived a life of reaction his whole life. And that's why I know what it takes to go to university on your own, because I did it. I also had an uncle who was very different. He didn't leave Zim in 1980. Oh, sorry, he didn't leave Zim at all. And in 1980, he opened an offshore bank account, and he was very successful in business there as an entrepreneur, basically as a stockbroker. And what was interesting is that by 2003, because he took his money and he invested some of it in first world assets with a first world income, and some of it locally, it allowed him the freedom. So by 2003, he decided that Zim was no longer for him and his family. He decided Africa wasn't for him and his family, and he wanted to move to Australia. But to get into Australia at the age of 53 is extremely difficult. It was hard then, it's even harder now. And so he bought his way into Australia. Yes, you can do that. And if you're interested tonight, you can ask questions later as to how you can buy your way into Australia, but you can do that. Secondly, he bought a house for cash in Brisbane, very nice house, and he bought it for cash. Thirdly, he sent his kid to Churchie, which is one of the best schools in Brisbane and in Australia, and his son has subsequently been offered bursaries to some of the best universities in the country. And ultimately, what I like most is he never had to work for an Australian. Now, a lot of people laugh at me about this, but the bottom line is that I can't think of anything worse than working, 20, 30 years of my career, going over to Australia and having to work for someone else, and ultimately I heard one Zimbabwean guy turn to me, he was in his late 40s, and he said, I was a general, and now I'm a foot soldier. So these were 2 personal experiences. My question is, what is your next move? You've got all this noise, you've got all these concerns, you've got not only concerns around South Africa, concerns around the global economy, etc., etc. What's your next move? Let's see if anyone actually knows what and how to ask a question. So just type up there. What's your next move? What do you think? Where are we going? What's happening? Okay, Malcolm says he's got no sound, but Jason, you hearing me fine? I'm on Firefox myself. Pierre van der Berg says that Australia is 75 for 3 off 17 over. So does no one have a next move? Dollar income, sound is fine. What else, guys? What else? Panic. Andre wants to panic. Secure and protect. What else have we got here? I'm going to engage with you. If you thought that tonight was just coming along and sitting on the fence and letting me talk at you, I was up till midnight last night, and I've still got a whole presentation planned for tomorrow. So I need to engage so we have a bit of fun. Okay, so there's only a couple of people that have a plan. Maybe that's why they're on this webinar. So let's go back into it. And you might or might not have seen the research that I did a couple of months ago. I went back as far as you can to 1978, and I looked at what would the impact be if I'd invested my money in South Africa and or America. So the exact same amount of money, taking into account capital growth, inflation, rand devaluation, taking the exact same amount of money in 1978, where would I be today? Would I be better off? So South Africa is the red line, and America is the purple line, and you would be 424% better off if you invest in America. Now, just by the way, you'll see here April of 2013 is when we started helping people aggressively invest in America. I don't think you would say that we've done too badly in terms of riding the wave of helping them invest. What about Australia? Well, taking the exact same amount of money between South Africa and Australia, you can see here that South Africa is the blue, Australia is the red. And very interesting enough, 499%. So you'd have 5 times more money if you'd invested in Australia in 1978 than if you'd invested in South Africa. And what's very interesting is that we started helping people invest in Australia right at this point, just after the GFC around March of 2009. Not too bad, I would say, in terms of riding a trend. You might call us lucky. I believe if you can do it in multiple markets consistently over time, it's more than luck, and I'll explain how we do that. And then what about the UK? So the exact same amount of money in the UK. You can see the blue line is South Africa, the red line is the UK. And ironically, you'd be 332% better off, or roughly 3 times. Now again, what's really interesting here, if you look at the graph, I started investing in the UK here in late 2001, actually, 2002. I stopped investing in the UK in 2007. Stopped. We did nothing in 2007. We started again in 2009 over here. So just as the GFC had hit, and we stopped about here in late 2010, early 2011, because I believe that the risk was still there. Now, you could argue that we missed the market. I personally think the market is very overvalued, and what's happening with Brexit at the moment is that people are starting to really take a hiding, and they're expecting some quite big shifts because the fundamentals haven't changed. So my question to you is, if you knew this, if I could put you in a little time machine, you could fly back to 1978, and you had R1 million or $1 million, would you put all your money into South African property? Because I pretty much guarantee that's what you did. Or would you put your money into English, Australian, and American property? Maybe a blend across them. And how Earth look today? What about your children? You know, 1978 to now is 38 years. That's called generational wealth. So, is it common sense? Well, I tend to argue with people that common sense is not so common, because we all know these long-term trends, and I don't think anyone disagrees that the trends are going to change in the short, medium, or long term. So what do? Well, I could see these trends. I could see these trends when I was yet a teenager. I did my first property project when I was 13 years old in Durban. I did my first development when I was 22 in Rondebosch in Cape Town, 6 townhouses. I did my first London development when I was 24 years old. This is in Wimbledon. We then went on to create IPS, which I started when I was 26 years old. We've helped thousands of people invest in South African property from overseas. We've helped hundreds invest in UK properties. We've helped hundreds invest in Australian properties since late 2008, early 2009. And we've helped hundreds invest in American properties. But the one thing that you have to understand about IPS and Wealth Migrate is that we're not going to pigeonhole you. We haven't been investing in London our whole lives, and we only make money if we invest in London. We're not going to tell you that you only invest in one market because that's when you make your money. We're going to help you with diversity. And since I met Henny in 2009, we also moved away from only residential houses and apartments to doing commercial, industrial, and developments. Henny started in Australia. I was there with him in 2009 with $4.5 million. They turned that into $44 million in less than 5 years. Today, that company is listed on the Australian Stock Exchange for $660 million. I think Henny knows a little bit about property in the Australian market. I'm so passionate about the space, I actually wrote a book, so I'm not going to go through it tonight, but Chermside actually endorsed it. We created a 4-dimensional model to help people know where to invest, when to invest, why to invest, and what to invest in. And you know, what I'm really excited about is where technology is going. And this is why we're at the FinTech Awards tomorrow. There's 3 major technological forces which are changing your life and making it for the better. The first one is the transformative power of technology. Look at what the internet's done. Look at Airbnb. Look at Uber. I mean, bottom line is they completely cut out the middleman. They reduce the costs. They increase the efficiency. They increase the transparency. And most importantly, they increase the accessibility. What about the adoption? You know, 20 years ago, most people didn't have a mobile phone. Now everyone does. Everyone has access to a computer. Everyone on this webinar, by the way. Everyone has access to the internet. And by 2020, they expect 70% of the world's population to have internet connectivity, if not as high as 100%. And then what's interesting with regards to technology is that there's also been a regulatory change. You know, we've gone from emails to social media, and now we're going to social commerce, which ultimately means that people are investing on the internet, and it's where things are going, and it's what really, really excites me. The old system is broken. You know, at the end of the day, you know, between the investor and the investment, there's over 16 different middlemen. People don't trust the system. There's no transparency. There's also no alignment. People invest in a property, an agent takes a huge commission. They're told that it's going to be X. It turns out to be Y, and they're the ones trying to hold the investment long term. They get involved in the syndication. ShareMax takes 26% on the front end. They bankrupt for years before it even gets back to real value. You know, and or a fund or a REIT, where they take management fees, they take a carry. They've got fees riddled all over the place. And I'm going to show you that just now. And if I'm wrong, why do only 1% of people in the Western world, forget South Africa, in the Western world, why do only 1% of people retire wealthy? Because the financial system is broken. Now, if you're going to get wealthy, you need to learn what wealthy people are doing. So there's a value chain to real estate. It starts with land zoning, then it goes to a developer, then it goes to an investor, then it goes to a fund or a REIT, and then who do you think it goes to next? Who do you think? Type it in quickly. Who do you think it goes to next? So Desiree, just while we're waiting for people to come up, Desiree said, are these projections based on the same investment vehicle? Yes, property. Boom, 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 boom. Okay. Jessica wants to know how much capital she needs to buy into Australia. Okay, so JP's hit it right on the head, and that's exactly it. It goes to retail investors. And so let's look at this value chain quickly. The average land investor, it's generally a long-term investment, quite high risk, and they'll be looking for an internal rate of return. Now that stands for, it's IRR, internal rate of return, and it's basically the best financial methodology to compare an apple with apple across different financial products. The developer will be looking for a 25% return, so they take the land, the raw land, and after it's been zoned, which is where the land developer makes their money, they then build a vertical structure and they ultimately create value on the land, and that's why they're called the developer. The next is the investor, and the investor actually tenants the building, so it creates income for the building, and it's called seasoning the rent. And ultimately, quite often, the developer and the investor are the same thing. So that could be buying a house and putting a tenant in it, and or it could be buying a shopping center and filling up the shopping center. Then comes along the REIT. So you meet any property person, any wealthy property person, and they make their money by taking a portfolio of properties, blending the return and selling it onto a fund or a REIT, because a fund or a REIT is looking for stable income so that they can pay their pensions, etc., their stable income returns. They're not aggressive, they take lots of fees, and ultimately they leave a lot of meat on the bone. And then comes along us, the retail investors, at the bottom of the value chain. And people wonder why they never make the money, like I just told you about Henny Besaidnout. If I'm wrong, there's an article on LinkedIn that I'd highly recommend you go and check out. Maybe Jason can find it on my LinkedIn profile and post it in the chat box. But either way, go to my LinkedIn profile, Scott Picken, and you'll see how I wrote an entire article around this value chain and how recently Rebosis has actually been, I mean, you can read the headline here, has been overpaying for Billion's assets. And ultimately, Billion is the developer, and they're selling, they're selling the properties into, well, Billion's the developer and the investor, and then they're selling the properties into Rebosis. And believe it or not, it's the same owner. And what they're complaining about here is that it's shopping centers that don't have season rents, that it's overvalued. It's a classic example of retail investors will come in and invest in Rebosis, and they'll wonder why they never get wealth. So you can see the article here. I'm not going to bore you. You can go in and read about it because we've got lots to go through tonight. If you want to understand our GID system, it's our global investment due diligence system. It helps us manage currency. It helps us decide which countries to invest in, which financial structures, which partners to partner with, which cities to invest in, which property to look at. It has a 142-point due diligence check. It helps us manage the properties. We have ongoing wealth assistance to really assist people and with our customer experience. And these 10 layers, it's our GID system that has helped us in multiple markets read when it was right to invest and when it was wrong to invest. Everything about investing is based on timing. You've got to know what to do, when to do it, and how to do it. And this is where our expertise of over 200 plus years amongst our entire coordinated team, we've helped and facilitated over $1.3 billion US investment on 5 different continents over the last 3 decades. So, just quickly, if I come back to this value chain, if you look at what we do, we cut out the REIT or the middleman. We cut out all the costs and the middlemen, and we just help people invest. So in the past, people wanted to be developers. Well, they didn't have the money, they didn't have the time, they didn't have the knowledge, especially in a foreign country. Well, now we can. It's what we call our growth plan. And it helps you with a small amount of money, as small as $10,000, and right now we beta testing $100, but for now, $10,000, you can actually participate in a growth plan. And that's like a development project. It's generally a 2-year project where you put your money in and you make a return within 2 years on the back end of the development. And or you can invest in an income plan. And our income plan is where you buy a stable existing building that has a lease in place with a rent roll, and you put your capital in. It's generally a 5-year investment where you get quarterly dividends. Very simple. The growth takes you to the development framework. The income takes you to the investor framework. And so as an example, from a growth plan perspective, this is Kensington. It's a 50-unit building in Brisbane. It's a building I've invested in personally, and I'm going to explain a little bit about this and why I invested. But this is a development project. It's less than 2 years with an IRR of just short of 20%, and ultimately allows people to be able to get involved in growth projects. It really helps you go up the value chain. You know, if you buy an apartment in Australia, you're making a 3 or 4% net return, and a lot of the meat is taken and made, a lot of the profit is made by the developer. Now you're going completely up the value chain, and you're being able to invest in the type of developments that helped Henny create all that wealth in Australia. And or, you know, so that building, I invested in that building. And interesting enough, here's the picture I was telling you about. So my son literally yesterday got his British passport. He's also eligible for an Irish passport, which we're also working on. But it's all good and well to have a passport. He needs to have a first world assets and a first world income. So I invested $10,000 in that building so that I could ensure that my son could have the future that he wanted. So I actually went and did the maths this week because of the fees must fall. And I went and looked at how much it actually costs to invest in the different universities between Australia, England, and America. Now, as a matter of interest, you can see all my workings here. You can see all my workings. You can go down and see all my references and all the websites. And then you can see the costs here. So you've got the tuition cost. Jason, just to confirm, can you see my spreadsheet?
It's rather small, Scott.
Or the small?
It's fine.
Okay, let me zoom in a bit.
That was in the best. That's all good.
Okay. So what I did here is I worked out what is the cost of an average university in Australia, America, and England. You can see the tuition cost and you can see the total cost. Generally, the total cost involves flights, accommodation, beer money, et cetera, and it works out about 80% above the tuition cost. You can see the total after 4 years in the different currencies. You can see the exchange rate, taking it back into US dollars because we need to have everything in one currency. And then you can see the total amount in US dollars. I then wanted to look at the 3 best universities. So the best one in Asia is Melbourne, University of Melbourne. Arguably Harvard is probably the best known university in America. People might not think it's the best one, but it's the most expensive. And Oxford's the most expensive in England. So I just want to know what it would cost to send them. If you want to go to any university in the world, what would it cost? So you can see the amounts here. So ultimately in dollar terms, about $131,000 in total for the average in Australia, $146,000 in America, and $106,000 in the UK. And then if you want to go to Melbourne University, you need $213,000, $326,000 if you want to go to Harvard, and call it $200,000 if you want to go to Oxford. So I went and I said to myself, well, what does that actually mean? So I wanted to work out if I took $100 and I actually invested it on a monthly basis, how much money would I have to be able to invest? Now, I wanted to take a 10-year term, so $100 a month, so these are US dollars, and I worked on 3 different variables, 6%, 15.2%, and 19.78. Now, what's interesting is that 6%, I worked out that the average capital growth rate of a South African property has been 12% for the last 30 years. So I put that in at 12%, but the Rand is devaluing at 6% a year against the US dollar. So if you buy a good South African asset, real estate, you should be expecting about 6% IRR in US dollar terms. Okay, so over 10 years, at $100 a month, I'll have $16,000. Now, if I put $100 into Cypress, which is our multifamily in America, which is an income-producing asset, my IRR is 15.2%, which means I'll have $28,000 in 10 years. And ultimately, if I invest in this one, this development called Kensington, I will have $37,000. Now you can see that I'm a bit short. Okay, so I even then went and worked out tax, because unfortunately when we make a profit we have to take off tax. So I took 30% off to work out an after-tax amount. The logic makes sense? Jason, does the logic make sense to you?
Yes, Scott, I get it. It's pretty straightforward.
So my kid's not going to university if I invest $100 a month. Or certainly not a university in America, England, or Australia. So then I went and did the maths, and I thought to myself, well, if I do it at $500 a month, with the exact same variables over a 10-year period, it gives me the future value, and it gives me the after-tax value. Don't worry too much about the numbers, because I put it all in the table for you. I then went, and I looked, and I said, well, if I invest $1,000 a month, and I use the exact same numbers over a 10-year period, it gives me my future value, and ultimately my after-tax value. And finally, my son is 4.5 years old, so ultimately I need to calculate it for 14 years' time so that he can go to any university. And you can see here that I've done the exact same calculation, the exact same growth rate. So just the only difference is the term is 14 years, the future value, and the after-tax. So you must understand that IRR takes into account cost, value of time, etc., etc. So I've taken that into account. I've taken what will it cost in today's money times 4, and internal rate of return takes into account the future value of money. So what does this get you? Boom, 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 boom. Well, if you look there, you've got all the amounts. So just to remind you, it's, you can see the amounts there: 131,000, 146,000, 106,000, 213,000, 326,000, 199,000. So in simple terms, if I invest $100 per month at 10 years over a 10-year period, I've got 11, 19, and 26. At 500, a month, US dollars, times 10 years, over a 10-year period, I have 57.98 and 131. If I invest $1,000 per month at 10 years, over a 10-year period, I've got 115, 197, and 263. And finally, over a 14-year period. What does this all mean? Well, let's see if my son can go to university. So what's interesting is that in yellow, so if I invest $500 a month and I invest it over 10 years at the type of return that I'm getting out of Kensington, my son can go to an average university in Australia. $500 a month. You can go to an average university in Australia. Not the best, you can't go to Melbourne, but you can go to an average university in Australia. At $1,000 a month, over 10 years, he can go, even with a Rand investment, he can go to an average university. With an income-producing asset like Cyprus, he can also go to any of the average universities anywhere in the world. And with $1,000 a month over 14 years, you can actually go to any university as well. But what's interesting is that $1,000 a month in a Kensington investment will now get you $263,000, which you can see in green, which pretty much allows you to go to best university, Melbourne and or Oxford, but you're still a little bit short for Harvard. $1,000 a month over 14 years, John T can now go to any university he wants in the world, anyone, including Harvard. And that's if you invest in Cyprus. And by the way, I've invested in Cyprus. And if you're interested in income-producing assets, we've got them as well, both multifamily and medical buildings. So just type in there, if you want income-producing, just type in income-producing assets. And interestingly enough, which I called the platinum, if I invest $1,000 a month for John T for the next 14 years, it's $629,000, and hopefully John T will have a sibling, and they can both go to any university they want in the world, and Harvard included. So what's your takeaway on that, Jason? While we've got the world map, where should people invest? What should they do? It's pretty interesting what the numbers are showing us.
Scott, we've got a quick question from Vanna Fools, just asking to compare the amount with inflation growth over a 10 to 14-year period.
So I did that. I took the inflation into account when I compared the investments in the US, the UK, and Australia, and compared it to South African property. So I took inflation, interest rates, Rand devaluation, but I took it all into account. And equally, in an internal rate of return, it takes inflation into account. So whether you invest in South Africa, the UK, Australia, or America, it doesn't matter. It's the same. It's the IRR, and IRR calculates the inflation. So Jason says, is that return a compounded annual return? Yes. Jason, that's the way you work out an IRR. So if it's a 5-year investment and it's arguably 15%, it's 15% per year compounding. Okay, I'm going to keep going. Hopefully that has opened some people's eyes. So if you invest in the right thing, you can invest as little as $500 a month, every single month, and you can make sure that your child can go to any university they want in the world. Before I move on, I do want to say that personally, my son will not be getting a free trip to any university because I personally believe that there's nothing more important than teaching him self-belief. He's already doing Lemonade Day, so if you want to learn about how to teach a child entrepreneurship and self-belief, go to lemonadeday.co.za. But what I think is important is that it's the mindset and the freedom that we spoke about earlier to be able to do it. So if people want me to, I'm going to go into, well, even if they don't want me to be frank, I'm going to go into some more detail around Kensington. I've shown you why I've invested in Kensington, and I only put in a smaller amount of money, but it's enough to send John T to any university in the world, and his sibling one day when my wife and I can figure that one out. So let's go into Kensington. Why is this a good opportunity? What is it about this opportunity? I've explained the why, I've explained the how, and now I'm going to explain the what. And the what is Kensington. So ultimately, Kensington is a 50-unit building. It's got 1 3-bedroom, and you'll see all the stats here in terms of just the look and feel. You've got the, all Australian developments at a very high level in terms of finishes. You can see the kitchens, the bathrooms, the showers. It's got the amenities and the pools. I think really from my perspective, we spoke earlier about how we have both income investments and we have growth investments. We tend to only invest in hard currencies, so US dollar, British pound, Australian dollars. We do believe in diversification. And what I love most about the platform now is you can invest in both income producing assets and you can invest in growth projects. And I've shown you the material impact that will have on your children and your family in terms of creating your wealth. So why are we in Australia? Why are we on the growth projects? Well, the bottom line is it's all about market cycles when it comes to real estate. So in America, we're still buying property, income producing assets, because they're below market value. Whereas in Australia, it's more expensive to buy existing buildings than it is to build. And so again, based on the development cycle, we're actually developing. In terms of our methodologies, at an income project, like I just explained, it's always got to be below market value, and we want an income right through the period, so really minimize the risk. And then the growth project is we develop when it's too expensive. We don't get an income through the project, but we share in the development project. The risk profile is different between the two. There's higher risk within the development, but ultimately there's higher return. And that's why I tend to split my investment portfolio up, and I'm not giving you financial advice. I'm telling you what I do myself. Some of it I put into income, some of it I put into growth so that I can maximize my returns. In terms of the population growth, you can see here why we're focusing on Brisbane. So if you know anything about the property market in Australia, as I said, we've been investing there for 8 years. You'll understand that Sydney and Melbourne are always out in the front, and then it's Perth, and finally it's Brisbane. They tend to lag about 5 years behind. So there's been huge growth in Sydney and Melbourne. I'd be very careful in Sydney and Melbourne. There's been massive investment. There's going to be large oversupply, and a lot of that investment has come from China and foreign investment. So we've seen this movie before. We know how it ends. But what's really important, and one of the most important dynamics that you need to look at, is population growth. And if you look at population growth in Brisbane from 2012 to 2031 to ultimately 2061, you'll see the population growth in Brisbane is pretty much the same as Sydney and Melbourne. The only difference is you need to see where it's coming from. Now, based on everything you've learned from us already, do you or don't you think that population growth is one of the most important and sustainable metrics to be able to work out both long-term sustainability of rent and income and also capital growth? So based on these stats alone, and this is what we do when we're looking as to where we invest and why we invest. We look for long-term trends. We don't invest on gut feel. It's based on understanding the research, putting it through our scientific calculations of goods, and ultimately giving us answers. In terms of the growth rate within Australia, you've looked at an average growth rate residentially of 8.3%. What's fascinating is that when you look at the growth rate, you've got the stock market crash of 1987, the dot-com crash, the Twin Towers, the GFC. You can see it a little blip. What was really interesting is they dropped their interest rates in less than 4 months, 8 times. To put it in South African context, they went from like 15% to 5%. They went from about 8% to 2.5%, 3%. And the market, literally buoyed by the second quarter of 2009, and then started to rise. And that's what happens in a very well-run economy, is that they can move quickly. Subsequently, the interest rates went up another 8 times, and it's why the market actually slowed in 2011, 2012, 2013, and now they've dropped interest rates again. You've got to be very sensitive if you're a short-term investor to what's happening in interest rates in Australia, because there's a dramatic impact on residential prices. So where is this place? For those of you who don't know, this here is Western Australia. Here you've got Perth. This is the Northern Territory. There you've got Darwin. Here you've got South Australia and Adelaide. New South Wales has both Sydney and Melbourne. Sydney's on the same time latitude as Cape Town, gets similar sort of weather. Melbourne is 2 hours south by airplane, and Brisbane is 2 hours north. It's just on you've got Queensland. Queensland, you can fit South Africa into Queensland. And you can see here is the Great Barrier Reef with all the different islands working all the way up. Now, what's fascinating is the development is right in the heart of the city. And so here you can see this is the main CBD here. You can see the river running through. This is the Story Bridge with the airport out here. So it's literally 10 minutes from the airport into the city. And the northern suburbs of Brisbane are the older, more established, more wealthy. It's where the better schools are. And this is really where the development is. It sits about 9 kilometers north of the CBD, very much in the good areas. And what's happening in Australia is that they're going through a policy of densification. So they had diversification, or no, what's it called? It's not diversification. But anyway, where they were building houses 30, 40, 50 kilometers away from the CBD. Now with traffic, with drink driving, with people wanting to be close to the hub, more and more people are moving in to be close to major transport nodes, and they're densifying the older suburban areas, and you're going to see that. What's really interesting, you see this transport node in here. So this is called a rapid transport node, and based on that, the town zoning really wants to have more medium and high density, so with bus routes and trains to be able to get into the city easily. Okay, you can see here in terms of the location, so you've got the location here, you've got the main road, I mean it's literally walking distance. You've got the major shopping center here, Chermside Shopping Center. My understanding, Jason, I'm not sure if you can verify this for me, but Chermside, you know, I hear this all the time between the different shopping centers, but it's the biggest in the Southern Hemisphere, is that right?
Yeah, that's what Richard Dunn tells me as well, so yes.
You can see here you've got Chermside Medical Center. Yes?
Just to stop you there, Andrew Cooper has a question. Just to ask if you've compared owning USA residential property and the returns from that versus investing in either the medical or Australia, taking into account the leverage achievable.
I haven't done it, Andrew, but I think one of the things that's very important in America, and we all know this, is that the cost of capital for residential real estate is still private money versus commercial bank financing, and it has a dramatic impact on the internal rate of return and the cash-on-cash balance. And for those people who own residential real estate like myself and many of our clients, it's why we're looking to retify the residential product and turn it into a commercial vehicle so that we can actually get commercial financing rather than trying to get individual residential financing for individuals. So if you're online and you're interested in that, just type in the word REIT. And if you're an existing IPS client with existing residential property, we want to digitize it, put it all on the platform. I know, Andrew, you went at the Wealth Partners update over the last 2 weeks, but I shared quite a lot around that because most of our clients, including myself, want to take our existing property portfolio, put it all on the platform, manage it all on the platform, and effectively digitize it and make it what we call hassle-free. You'll see here at Chermside, you've got the hospital here, so these things are relevant when you look at the distance, and then you can see here, you're literally walking a couple of minutes down and there's a bus stop right here, up and down a main transport node. This stuff is incredibly important. I lived in London for 9 years. If you lived more than 10 minutes from a station, I call it one of the rules of investing in London, the 10-minute rule. If you own a house more than 10 minutes, you'll really battle to get tenants. People don't want to walk more than 10 minutes. So it's, you know, Brisbane used to be a society like South Africa where everyone drove cars. It still is to an extent, but it's becoming more and more like London with access to transport nodes. So you can see here with a 3D view, you can see the hospital I spoke of. You can see where the development is there. You can see Chermside Shopping Centre. I mean, literally walking distance. You can see Brisbane is 9.5 kilometres in this direction. And what's interesting as well is you can see the densification. So you can see it's old suburban neighbourhood. They've obviously bought a number of houses. They've consolidated, they've rezoned, and now they're turning into a 50-unit medium density development. So it's just from another angle, you can see the size of Chermside Shopping Centre, and I think you get the point with regards to Chermside from the other side. Okay, and you can see the size of the hospital as well. It's not a small hospital by any measure. So this is just a picture of Chermside Shopping Centre. You can see the Prince Charles Hospital. These are major facilities, and what do major facilities need? They need nurses, they need shop attendants, they need people that will be your tenants, and all the homeowners, by the way. So Chermside is recognized as one of Brisbane's highest growth suburbs, 10 kilometers from Brisbane CBD. Over the past decade, Chermside has witnessed significant economic growth underpinned by major infrastructure investment. I think I explained that earlier about the rapid transport nodes and how important that is. The latest population projections by the Queensland government is that it's going to increase from 8,500 people to 18,500 people over the next 20 years. Now, coming back to what I said about population, good or bad, is that going to be good for sustainable and long-term growth? Translating that into average, it averages out at 3.5%, which is higher than Brisbane and Queensland are higher than the rest of the country. And based on these projections, there's going to be a shortage of 4,250 dwellings over the next 20 years, which is why they're allowing medium density to be built. Chermside ranks in the top 10 areas for employment in Brisbane over the next 20 years. The health and community services are the major employment base. The Queensland University of Technology has 17,000 students. So again, tenants don't live in old houses like I used to. They like to live in nice modern 1, 2, and 3 bedrooms, especially international students, which is the second biggest export of Australia. Chermside contains 2 large hospitals that employ 3,500 people, and it's 500-meter walk. And Westfield is one of the largest retailers with over 400 retailers. I mean, I don't know how many people work in the average shop, but let's say it's 2 or 3. That's another 1,000 jobs just within walking distance. The rental demand is over 60% of the dwellings are under rental tenure, which means they're long-term rents. Long-term is not 12 months, it's more than 3 years. And the current vacancy is 2.5%. So you think about that. If there's 100 properties, the vacancy across 12 months is 2.5%. In South Africa, it sits at about 8% and is actually rising generally, depending on the area, as high as 12 to 16% in many instances. Suggesting demand for rental properties is outstripping supply. So 3% is the average vacancy across the country, and it's currently sitting at 2.5%. And the market has bounced back in terms of growth rate of average of about 9%, which, as I showed you earlier, the Australian statistic is 8.6 across the board. They're looking for 1,000 apartments per annum over the next 10 years, and there's a high level underlying demand point. So you can see here, it's all the stuff that is common sense of what is happening and why it is happening. I'm going to kill this person. So we also don't invest in property, we invest in people. We're only as good as our partners on the ground. So Richard Dunn, who's my colleague and full-time partner on the ground in Australia, has extensive experience. I've never met anyone. Excuse me, I'm not available and you can't call me for another hour. Is that understood? Sorry, I'm getting frustrated. So anyway, Richard Dunn has scours the market. He's worked in this market for nearly 2 decades now. He knows all the top developers in the country. He has amazing relationships. I met him through Ozinvest, which was one of the biggest investment companies in Australia. And because of that, he's got relationships with all the top developers. The BARRATT Property Group has actually completed over $181 million worth of developments. You can see there 75 apartments, 271 apartments. They've done a retail center and a shopping center. So our most important criteria is that they've got 10 years plus of experience. We also like them to focus. You can see here that they've focused on apartments and retail shopping centers. So we like the fact that they understand the space. And lastly, they've got to put capital in, which the BARRATT Property Group are doing, so that our investors are aligned, so that we've got our money, our investors have got their money, our partners, the BARRATT Group, have got their money, and all our interests are aligned long term. And we learned this from Henny. In terms of just some of the developments they've done, I think you can see that they're more than just bucky builders in terms of the size and scale of developments that they've done. You can see the different retail centers and then the different residential developments. This is the development. So again, if you're interested, you can go on the platform and wealthmigrate.com, and you'll have access to all this documentation. The plans were approved. It's very important to have the plans approved, because we have had a situation in the past, and Henny's the one who taught me this, where you can invest in a project and then the plans aren't approved and it delays and it drags and it drags and it drags. So it has all its planning approval. We wouldn't invest without it. So it's called its DA. But you can see here the design of the building. You can see here the floor plans and all the recreational areas. So I'm not going to go into too much detail, but you see the pool, the media room, the open area. These are parking lots. You've got a lobby, so very, very professional entrance. In terms of where, and then these will all be open areas with gardens, etc., etc. Okay, then you've got the floor plans. You can see here that it's a mixture, as I said, of 2 bedrooms and 1 bedrooms, except for a 3-bedroom penthouse. And so, Jason, could you remember? I can't remember off the top of my head the split between 1 beds and 2 beds. I want to say 1 beds are 18 and 2 beds are whatever the difference is, 21 or whatever it is. Jason, come in, Jason.
Yes, Scott, I'm here. So as far as I can recall, I think it was a 1 3-bed unit. Majority are the 2s and 1s, but the total unit is 50. I'm not sure of the exact numbers offhand.
Yeah. No, it's about, I think I've got it pretty much spot on. So you can see there the different price range that they'll be coming out at. So what I like about this is that, Henny taught me from 2009, he doesn't like to be in the bottom end of the market. He doesn't like to be in the top end of the market. He likes to be, in the mid-range market, which is the market we've been very successful in Australia, investing kind of between 300,000 and 600,000. That those prices have moved now, so it's probably 350 to 650, 700. But you can see here, a mixture of 1, 2, and 3 bedrooms, and you can see here the spaces, you can see the external, and you can see the selling price. One thing that's really important here is that they put balconies on all the units, so that increases the size, it increases the demand for tenants, it increases the sale price later down the line. And what's interesting is we've had a number of investors that are investing in the project, and rather than taking a profit on the end, they're actually rolling their profit into owning units. But I think because you saw what I showed you earlier about the value chain, they've now gone up the value chain, so they'll get more bang for their buck in terms of their money, in terms of where they actually are. So, this answers my question I was coming to. The project has a development approval for 50 apartments, 14 one-beds, 35 two-beds, and 1 3-bed. You can see the price ranges there. So 375 to 405, and then 475 to 560. In terms of what you're looking at. The average rental returns are 5 to 6%. All of them have the balcony, like I discussed, the 7 to 8 meter balcony, and there's lots of amenities, a pool, the spa, barbecue, and common areas for residents. And then again, this is very Australian, but everything, the finishes are always immaculate in Australia. It doesn't matter what level of development, because that's what Australians expect. In terms of the numbers, if you're interested in Latham, I highly recommend you talk to one of our investment consultants. They can take you through it. But I mean, you can see the total development cost is just short of $15 million. The land cost is $2.6 million. The finance charges on the senior debt are $1 million. The project management, so this is our project management cost to make sure that the project's managed right and that we have the cost controls. We're going to employ a QS to make sure that we're looking after the costs and managing our investors' interests. And this is, again, what Henny's done before to be highly successful. In terms of the setup costs from a due diligence perspective, the amount financed, so it's at a 70% loan to value, so 70% debt, 30% equity. You can see the equity contribution there is $4.6 million. The investor profit is $1.5 million. That means the return on investment is 26%, which with an 18-month holding period puts the IRR at just short of 20%. It's about 19%. And then what's also interesting, what just happened there? Just give me 2 seconds. I'll go back to my numbers there. I love a Mac every now and again. Sometimes you press the wrong thing. The other thing, when you look at the investment summaries, again, we're not financial planners, we're not tax experts, but we are, quite experienced investors, having done this for more than 30 years. In turn, when you look at someone like Henny and myself, it's 18 years now, and plenty of people like Dr. Dolph DeRoos and Michiel and Richard Dunn. I've been doing this for a very long time. So what we did is we took a minimum investment of $10,000, see the cash flow from a pre-tax perspective. So you can see the return pre-tax, you can see the return post-tax, and you can also see the internal rate of return, because remember it's over 18 months. So the internal rate of return pre-tax is 19%, 19.78, and the internal rate of return post-tax is 15.83. Now this is quite conservative. We've Grant Thornton helped us set up our structures and make sure we're tax compliant. I know that Michiel's been working some magic there, but let's say that we're on the conservative side, and that's why I took off that 30% earlier, to be realistic, because it's not all profit in terms of putting your child through university. So the minimum investment is $10,000. The project duration is 18 months. There's the 3-month development preparation equity raise, which we're actually coming to the conclusion of. There's a 12-month construction period, and there's a 3-month handover period once the sales have actually been made. The investment is not available to Australian investors. The reason, because of ASIC, so it's got to do with their internal compliance. And just in terms of the deadlines, the first deadline was met by the 8th of July, where we had to invest $2.8 million, which we've done. By the 5th of August, we had to put in another $0.7 million. And by the 21st of October, which is pretty much in the next 2 weeks, there's the final $1 million. And my understanding is that, that's there's quite a lot of heavy demand for that. So it will be on a first come, first served basis. I understand the timing is tight, but the development's ready to rock and roll. And when Richard was here, he was saying that they're very ready to break ground now in terms of where we're looking at. So just in terms of the timing and what needs to happen. And then, if you are interested, contact one of the investment consultants, whichever investment consultant got you online tonight, and or just type in there Kensington, and someone will contact you tomorrow. Go on the secure website, wealthmigrate.com. You can sign up. You can even go into the chat room. I don't know if anyone's working now because it's quite late at night. Follow the process. So you just register from a KYC perspective. It's just know your clients. It takes a little time just to 5 minutes just to set up with your ID doc, etc. But you only have to do it once. And then choose Kensington to invest in. And while you're there, you could do what I did, which is invest in Kensington and Cypress. And then you've got the benefit between an income-producing asset and a growth-producing asset, which hopefully I've explained. Now, before I take some questions, I just want to share some other stuff that's really important, which I don't have slides for, but it's from experience. There's 4 reasons that you want to invest in Australian property that have nothing to do with property. 1 is it helps you immigrate to Australia. 2 is it helps you build a credit rating in Australia. Now, my uncle, when he moved to Australia, and even though he had all that money and bought his house cash, he couldn't get a mobile phone because he didn't have a credit rating. So if you're thinking of moving to Australia in 5 years, then I highly recommend that you start operating Australia. Get a bank account, start getting credit rating. Start, we've got a slogan, start living before you leave. Now, I don't want to leave South Africa, like I said, but I've got my plan B in Brisbane, and I've got my plan B in America already. And I am building my credit rating so that I don't have that problem. The third thing is that there's a lot of tax advantages of investing in residential real estate, and you can write off those taxes. You can accumulate a loss, and ultimately, when you move to Australia as an income, once you start earning an income, you can offset those tax losses against your income, which gives you a good footer. And then finally, if you invest in investment products, you don't try and go to the Gold Coast and buy a house that you want to live in. You invest in something that's going to make a good return on your capital. And remember, it's not only return on capital, it's also return of capital. So it's all about safety. We're not interested in we're interested in doing things that are simple and safe. We're not interested in making cowboy bets, and that's why Henny and the investment committee. It's all about safety. It's return of capital first, and then it's return on capital. And ultimately, what you can do is if you move there in 4 or 5 years, you go and rent for a year or so. Make sure that you know the area you want to invest in, where your local golf club is, where your friends are, where your kids are going to go to school, and then you can buy. And it's your assets that will ultimately help you buy. And I've got real stories of this. Ryan bought 5 houses from me in 2009. He moved there in January this year. He sold off his houses. He remortgaged a couple of them. He's bought himself a beautiful house on the Gold Coast. He told me in 2009 that was his plan, and it's really gratifying to see that assets can really, first world income or the first world asset can really help you turn your dreams into a reality, just like what happened to Ryan Boyter. If you want to immigrate to Australia, there's 3 ways to get into Australia. The first way is on the points-based system. You've got to be less than 45, and you've got to have a skill, a recognized skill. Those have dropped over the years. I don't even know the number now. It was over 400. It's dropped to less than 200 now. And or you can go in on a business visa. Those are getting more and more expensive. I don't even want to quote it now in terms of the amount, but my understanding is it's about $500,000. You've got to employ 3 Australians and show you're producing an income. And with developments and stuff like this, there is a way to show them to be able to look and show it as a business, particularly if you become a significant investor. And finally, a significant investor is where you actually investing. It's $5 million. The laws keep changing around it, but there's been a significant amount of investment from Asia where you invest $5 million, and ultimately after 4 years they give you your citizenship. So, like I said, you can buy your way into the country, and that's why I've got my son his British passport. I'll get him his Irish passport. But what I'm much more interested in is in becoming a global citizen, and myself and my wife building up first world assets with a first world income, because that'll give him the freedom to travel and live anywhere he wants in the world. So I know it's a huge amount of information, but let me get into some of the questions now. Right. Someone said, can they see the recording? Yes, we'll send it. Work out a way and how much capital we need. So Jessica, if you want the details of network migration, they're one of the top 4 immigration agents in South Africa. They move something like 1/4 of the families to Australia and to Canada, I think, and New Zealand. Andrew is there. I've worked with him since 2007, I've never had a client give me a bad, update about them. So if you're interested in network migration, Andrew, just type in their network migration. We can put you in contact. We're not immigration experts. They are, and they can tell you what to do. Right. Boom, boom, boom. All these projections. Yeah, I answered that one. Please compare the amount with inflation growth over 10 to 14 years. So Werner, as I said to you, I think I covered that with the internal rate of return. It takes into account inflation. Jason, I did answer your questions. So this one here from Sevi. With what you know and few jobs for students that finish varsity, do you still believe that varsity is the way to go, or rather focus on entrepreneurship? So great question, Sevi. I did answer that earlier. I don't believe that varsity is necessarily the way to go. And it's why I'm teaching my son. He's 4.5 years old, and I'm already teaching him entrepreneurship skills and self-belief. Again, go check out lemonadeday.co.za, and you can, hopefully, help your kids. Any kid from 8 to 16 can be helped. I'm just starting my son early at 4.5 years old. Who knows where the future is? When you take Khan Academy and the fact that you can access Harvard and Stanford online now, you'll have access to the best information in the world. The one thing I will say to you, having done an undergrad degree at UCT, it really shaped me for who I became. It helped me to think, but more than that, it's the person I became, the people I hung around with, the self-confidence I got. I've got some of the best friends. I'm one of the luckiest guys on the planet for the people I met at UCT. And that really shaped who I became as a person. Now, I did my master's in London, and although I did it full-time, it was on top of a full-time job. I didn't stay in res. I didn't meet one person. I don't have one friend from London University where I got my master's. Both of them are cum laude. But the point being is that, that was just rote learning. I just learned the stuff. I got the information. I got the degree. So I come to challenge it. It's more about community and the person you can become. And I think there'll be somewhere in the middle, personally. Rion asked for the Twin Towers was in 2008. Okay, fair enough. I don't think so, Rion. I think it was 2001. If you go look, it was called 9/11. 2001 was when the towers got knocked down. Andrew Cooper said, Scott, have you compared? Okay, I'll answer that one for Andrew. So he's put in their REIT. I'd highly recommend the REIT. Andrew, I'll be doing it myself. JP asked, has there been any recent developments in the area that provide sales success in the area recently? So that's a good question, JP. And if Jason, if you can answer that, my understanding is that there's been significant demand for apartments and affordable accommodation close to the CBD, which is in that ring road area. And so my understanding is yes. I don't off the top of my tongue have exact comparables for you, but if you wanted those comparables, just type in their comparables, and I guarantee you one of our investment consultants would be able to provide it for you. Ravi's asked what's the total cost of development, so I answered that, Ravi. It's about 15 million Australian dollars. Vili said, so Vili, one of our investment consultants who's been with the team for many years, one of the most experienced, will be online. So if you want to go online and use the chat, you can actually go online and chat with Vili directly if you don't like talking to me and you want to get more specific details. So thanks for that, Vili. Andrew said, how long until the REIT structure for residential arrives? Great question, Andrew. We've actually set up a project called the Hassle-Free Project. Kevin, who's one of the most intelligent and best assets we've got now, is heading that project up full time. We see it being a long-term project. It's not going to be an overnight project, but my understanding is he's literally putting the finishing touches on putting a survey out to all the current investors so that they can consider their different options. So we're working on it as fast as we can, Andrew. Ravi said, what is the website again? 11-8 day. I'm sorry, I'm not sure what 11-8 day means, but the website is wealthmigrate.com. You should be able to see it on the screen. I did leave that screen live. Oh, hang on, I'm just going to the, no, you should be able to see it on the screen there. So it's wealthmigrate.com. Jessica said, is there a way that my husband can watch the seminar? Is there a recording? Yes, Jessica, we will put it up on YouTube after the recording. And if they want to ask questions, you can go on to wealthmigrate.com and talk to an investment consultant in terms of getting the latest information and speaking to human beings. Okay, any other questions? A lot of information. You know, to recap, when I look at my uncle's situation, what we hear is it's all about passion and purpose, and our passion and purpose is to provide people with that freedom. And again, I repeat myself, you know, if you take my father or you take my uncle, you know, my dad lived a life of reaction. That's because he didn't plan, he didn't have a long-term strategy. My uncle had a long-term strategy. If we get junk status and the rand devalues and or something else happens, it's too late. It's people that plan, it's people that are proactive, it's people that have strategies that ultimately become wealthy and look after their family. And that's why I said to you, there's 4 things I'll give you tonight. Peace of mind, wealth preservation, a plan B, and most importantly, a way, a vehicle to be able to create the freedom for you and your family so that they can go to whatever university, and I'm just using that as a metaphor, that they want. Jason, you had something to say?
No,
Lemonade Day.
He's got a... Yes, regarding
Okay,
the
so I'll just type
Lemonade
in the
Day.
Lemonade Day. Actually, let me just, because I've mentioned it a few times, let me just go back to here. This is what you call doing it on the fly. lemonadeday.co.za. Boom. There we are. That should keep everyone happy. So that's lemonadeday.co. That's a charity that I actually got. They train over 300,000 children in America. I persuaded them. They told me no, but I'm not very good at the word no. And I persuaded them to let us bring it out to Africa. We've done pilot projects. You can see the projects we've done. We put kids through private schools because of it. Little guy called Bongi. And yeah, I highly recommend going and checking it out. Whether you invest in Kensington or not, make sure that you teach your children about entrepreneurship, money, profit and loss, balance sheets, how to do sales, how to run a business. There's 12 skills to running a business. It teaches you how to do it all. And most importantly, it teaches them self-belief. But personally, I'll do both, just like I have. I'm not telling you to do what I haven't done. I've personally invested in Kensington. I've personally invested in Cyprus. And I'm personally teaching my son about entrepreneurship skills, along with getting him a passport so that he's got all his options covered. Okay, are the cutoff dates the same for clients moving funds out of South Africa and people who have money in offshore accounts the same day? Great question, JP. Jason, I'm not sure if you can answer that. I think it's more a deadline for the money needing to be in the account in Australia. And so if you're moving your money offshore and you've got to get your tax clearance and everything, you need to seriously hurry up and vocal because we're running out of time. If your money's offshore, then you know it's the same day or 2-day transfer. But I mean, realistically, if you're interested in Kensington, you know, I don't like rushing people, but this is a project that's about to go live. I mean, to put it in perspective, I put my money in over 2 months ago. It's been going through that 3-month development period and getting all the financing and all the marketing material and everything done. And now they're going into the ground, and that's why the milestone has arrived. So just jump in, Jason, if there's anything I'm not answering right. I don't know everything.
Yes, Scott, no, that's not a problem. Look, if they're moving funds out of South Africa, it usually takes up to 4 working days to land, so the sooner the better. Obviously, if the funds are already lying offshore, it is a little quicker, up to 48 hours, sometimes a little quicker, but 48 hours is usually a safe bet.
Cool. Okay, well, I've either bored you to death, I've confused you to death, and or I've answered all your questions. But are there any more questions? I'm happy to stay online for another couple of minutes. And then I've got to go and find Jay and Yakut to start preparing for the FinTech Awards. Oh, and by the way, do me a favor, and hang on. Like while we're here, hopefully I've added lots of value. I worked really late all last night and today to do all that maths. I want to just give you something quickly. So we put it up on Facebook. Give me 2 seconds here. And Jason, I'm going to put this in the chat box. So people, I would really appreciate if people could go vote for us for the FinTech Awards. They are closing tonight. We are in the top 5 in the entire continent of Africa. And, you know, I would really appreciate it. Take you a minute of your life. Go in and vote for us. We really passionately believe in what we're doing. We know that technology can change things. You know, ultimately, I as a kid, I'm gonna do the talk tomorrow, and if you're interested, we'll share it with you. But you know, as a kid, grew up loving Monopoly. I mean, I've actually got it here. This is the Monopoly game that I learned, and I think it's, you know, I love technology. I did my first programming course in Logo when I was 6, and I always wanted to like build a world where we could have technology and property married together. And with our incredible team, we've now turned a game into a reality. Now I bought this game here for my son, which is called Global Monopoly. So it's actually got the different countries around the world. You'll know that old Monopoly was just country specific, very much like investing. But now we've turned Global Monopoly into a reality. You can invest $10,000 in an income producing asset in America. You can invest $10,000 in a growth product in this development in Australia. You can manage everything off your dashboard, and ultimately you can create global monopoly. You can learn to do it. So I'm super excited about it. Our mission is to empower 1 billion people and literally solve the wealth gap. And I could go on about this for a long time, but all I ask is please go online tonight, take the time. If you've been online, hopefully we've added value to you, and all I'd ask in return is for you to vote. And if you think this has been interesting, Jessica said about sharing it with her husband. If you think there's friends, if you go to a Brian, they're complaining about, fees must fall, give them solutions. I'm sick and tired of South Africans complaining. Give them solutions. That's what we do. We give them solutions. So, at the end of the day, like Henny said, I get to live in South Africa, so does Jason. Every single person in our company has invested in overseas property, right down to Bongi, the lady that actually helps clean the different offices. They all have invested overseas. They all have first world assets. They are all earning a first world income. We live what we breathe. And for me, as individuals, I just ask you to let others know about it. Empower them. Give them the solutions. I'm sick and tired of hearing South Africans complain. Okay, Sekilo, Scott, please advise, why is it better to get 18% return on investment from Australia if I'm able to get 35% in South Africa? Great question. Sekilo, there's no right or wrong. You can't blanket one country over another. I would take a couple of things into account. So on average, the Rand has devalued by 6% year on year over the last 30 years against the US dollar. We've seen currency shocks. I don't think was it last year where the Rand lost 32% against the US dollar. Sure, it's recovered, but it didn't recover anywhere near 8 Rand to the dollar, which is what we started investing in America at in 2013. And if we have a currency crisis, if we get a downgrade in December, which seems to be very likely, I think the Rand's going to fall out of bed completely. And I just don't like having all my assets tied up in one basket. If you had all your money in Christchurch property when they had the earthquake, you would look like a bit of a sorry fool. If you had all your money invested in American real estate in 2007, where it lost 70%, you'd also look like a fool. Why put all your money in one asset class, in one country, in one currency? So I would say to you, Sekelo, if I'm pronouncing the name right, I hope, invest in South Africa. Make a return in South Africa. It's a great country. There's great opportunities in South Africa. But just like Michael, park some of it overseas, put it in a first world asset where you can get, that wealth preservation, that plan B, that peace of mind. And ongoing, long term, I've proved to you that if you invest in Australia, England, America over a 38-year period, you're actually better off than investing in South Africa based on long-term averages. If you're getting 38%, keep doing it, but park some of that profit overseas. Ravi Govender, what is the deadline for investing? We're expecting income at the end of December to be able to invest. So Ravi, you won't be able to invest in Kensington because that will be long gone. But we do have a pipeline. We've actually got a $3 billion pipeline out of Australia. Henny signed the deal last week. And we've got a couple of $100 million pipeline out of America. Henny's currently there actually signing up deals. So you get your money ready, and when you're ready, we'll have a good project for you. Graham said yes. Did vote for you, so thank you, Graham. Andrew said thanks. Sekilo said, I asked because I don't plan to move band. I asked because I don't plan to move band, want maximum growth on money. Yeah, so I think I've answered your question, Sekilo. I guarantee you Warren Buffett doesn't put all his money in the most highest growth, highest risk investment he can find. I think some would call that gambling. You can get 100% growth on your money if you go to the casino and put it on red or black. Have an awesome presentation with the FinTech Awards. So thank you, Michael. Rion said, who can help me with consolidating my property portfolio in South Africa? Rion, great question. And boom, for the record, our Wealth Migrate platform, we're now getting the licenses to be able to do South Africa. So we'll be launching South Africa in the first quarter of next year. And I've helped a couple of thousand people invest in South African property, including myself. And so you've got two choices. You can either sell off your properties, which I've done. I'm sick and tired of South African residential real estate, if you want my honest opinion. So my wife and I have sold off all our properties. I think we've got 3 left now. And we've taken every cent of those properties, converted them into overseas currency, and been investing in Australia and America. That's why I've told you what we're doing. I plan to, like I spoke about a REIT with regards to Andrew, I'd ultimately like to form a local REIT with all our South African properties, make it consolidated, make it a commercial asset. Once again, go up the value chain. Once again, that's where the money's to be made. Okay, so Kilo said thank you. Jessica said thank you. Great information and authentic. Thank you, Jessica. And John said thanks. Freddie said thanks, Scott. We'll be in touch. So, guys, I think I've hopefully answered all the questions. Jason, have I missed out anything? Anything you want to add, or any of the investment consultants want to add anything?
Scott, you seem to have answered all the questions that were presented. So from our side, I just want to say thank you to everyone that attended tonight's webinar. Thank you to Scott for presenting as well. Guys, you can see the next steps on the screen. So if you do require any additional information or you have some questions, speak to your investment consultant. Alternatively, if you haven't signed up yet, go to www.wealthmigrate.com, sign up, and you'll also be able to view the full list of investments on the secure site.
With all the information, so all the plans I showed you, all the modeling, all the returns, the cash flows, it's all there. Welcome to the world of technology. Let's make lives a hell of a lot easier. So I endorse you, Jason. Thank you very much. Thanks for being online and helping as well, and making sure the webinar didn't go down when my computer ran out of data in my hotel room. But hopefully we've added some value to people. I love doing this. I'm very passionate about it. And please tell people about it. Let's empower South Africans. And if nothing else, do me a favor tonight and go and vote for us. My father always taught me that no one remembers who comes second, which is why I'm probably so driven and competitive. But I think that's enough for tonight. Thank you, everyone. Thanks for being online. We really appreciate all your time. To the investment consultants who are online tonight, I saw Billy, I saw Teresa, I saw JP. I'm not sure if there were others online, but great to have you online, and hopefully I've shared some value of all the work that I've done in the last 24 hours of how we can get around fees must fall and how we as South Africans can have solutions. So thank you all. Have a good night. Cheers.
Have a great evening. Cheers. Bye.